In this video, I'm going to discuss the statement of cash flows, and I'm also going to give you some examples of some items that trick students in the preparation of the statement of cash flows. I'll also have separately from this video another video where I'll do an example of an actual preparation of cash flows, statement of cash flows, and that way you can see how these items actually come together. But for now, let's look at some notes regarding the statement of cash flows. In very simple terms, the statement of cash flows is just providing us with information on cash in and cash out. Okay, so keep that in mind. And we're separating this into three main activities. The operating activities, which will give us insights on the ability of the firm to continue as a going concern. And what this is, these are the transactions related to the operations of the business. So usually this is going to be related to income statement accounts of operational activities. And the other two categories, investing and financing, will give us insights into the change in assets and liabilities, the long-term assets, long-term liabilities. Okay, so let me include that in here. Whereas the operating activities is mostly focused on your working capital accounts or your short-term assets and short-term liabilities. So why is the statement of cash flows one of the statements included in the annual report of a company? The first thing, and this one may not be as apparent to you, but based on academic research and based on many years of findings that support that, the idea that if we understand the company's cash flows in a particular period, it can actually help us predict future cash flows. And this is not as initially might not be as apparent as to why this is so important, but the idea or the potential to be able to estimate future cash flows is a very important thing for business people. And we have documented that net income itself has some predictive value in being able to come up with future cash flows of a business. And the same thing goes for the actual cash flows of this period. So because of that, this statement has a lot of value to investors and financial statement users. Okay, and this is a little bit beyond the scope of what the purpose of this video is, but it's good to have an idea that there is this value beyond just understanding what the cash in and out is. Plainly, it also gives us insight into the ability to pay, right? An ability to for anybody that wants to see a company's statement of cash flows can get that insight, whether that company has enough cash flow to be able to pay. Especially if we look at operating activities, we would like cash to be coming in from operating activities because that is the bread and butter of the business, right? But sometimes we must borrow money, we must issue equity, or maybe sell some of our property, plant, equipment. And those are also sources of cash flows that potentially we can see in terms of determining the ability to pay for that company. Another important item that we see on the statement of cash flows, if we're using the indirect method, which most companies are, is that we see a reconciliation between what is net income on the income statement and what is possibly referred to as cash income. In other words, if we did not have this idea of the accrual method, if we were under the cash basis, then this would be our cash income. All right. Now we understand that we are under the accrual method, so we have revenues and expenses for which maybe there aren't cash flows related to them directly at that moment, and they do affect net income. But if we think about cash income, these would only reflect things for which cash came in or cash came out. So by us doing that reconciliation, we can see that under the indirect method. And ultimately, this statement, the statement of cash flows, can help explain how we got from the beginning balance in cash to the ending balance in a period. So that's important information to have, okay? A little bit about the sections of the statement of cash flows, a little bit deeper. So operating activities, you can present it either under the direct method or the indirect method. If you choose to use the direct method, this involves directly figuring out what cash was from customers, from suppliers, items related to operating expenses, etc. And this can be, for a large company, this could be it could be a challenging task. So for that purpose, we are allowed to use the indirect method. And here's the other thing that makes it kind of weird. If you do choose to use the direct method, then you're also obligated to disclose the indirect method. So what ends up happening is that most companies just present the indirect method. That way they don't have to do two approaches for the statement of cash flows. So it's, it's like 99% of the companies do this. All right, so how does the indirect method work? The indirect method involves reversing out any non-cash activities that are included in net income. So anything that is included in net income that really did not require cash in or cash out for that period, then we just reverse it out. And by doing that, we'll arrive at that cash income that I mentioned earlier. In general, the way this works is we analyze any changes in working capital accounts. So these are your accounts receivable, your inventory, your prepaids, accounts payable, all these current assets and current liabilities. Those are your working capital accounts. And we analyze changes in them. And then we, based on those changes, we reverse out whatever is non-cash related from net income. And in a minute, we'll go ahead and do that so I can show you some of the items that normally we see. Investing activities, even though we're not technically saying it, the investing and the financing activities are both done directly. Okay, companies do not have many transactions involving investing and financing activities in general, and because of that, we can actually go directly and analyze what the actual transactions were. So this is, this is even if you're preparing the operating activities under the indirect method, technically you're preparing these two sections under the direct method. For investing activities, this involves analyzing changes in long-term assets in general. And then for financing activities, involves analyzing changes in long-term liabilities and owner's equity accounts, such as borrowings or issuance of stock. And then for investing, such as buying or selling your long-term assets, your property, plant, equipment, or such. Okay, so this analysis for these two items is not necessarily difficult because of the fact that you're recreating the transactions to see what the cash flow implications are for the statement of cash flow. So that's not hard. But sometimes what is a little bit difficult for some students to understand is the indirect method of the operating activities. So I'm going to talk about a few things here. The setup I'm going to do here is these are the common items to consider under the indirect method. So here's the main thing. We start with net income. Okay, I'm going to bold that. We start with net income. Into net income, we add or subtract a whole bunch of things. And here's the main breakdown here. And I don't want you, I hope you don't try to just memorize this. I hope you you can try to understand this. But for current assets, any decreases in current assets, that would be added back. So for example, if accounts receivable were to go down for a particular period, you can think of that as you having received more collections than sales on account. And because of that, net income is only reflecting the sales on account. So you would want to include that extra cash that was collected, and that's why you would add it. So a decrease in accounts receivable means you collected more than you sold on account during a period, and you would add that back to net income. Because again, we're going from net income to some item called, nobody calls it this, but this is the way I like to think of it, cash income. Okay? And the same analysis can go for accounts payable if you wanted to do that. If your current liabilities go up, then you add it. the net amount that goes up. And the opposite is true for subtraction here. So those accounts like accounts receivable, inventories, accounts payable, etc., those are easy to analyze. And what you're doing is you're simplifying your life. You're, instead of going in there and directly trying to figure out what happened within each transaction during the period, you're taking one summary amount of the net change within the account for the whole period. And that simplifies the process, right? And that's indirectly arriving at some form of cash income. So those few accounts that you can analyze like that, that's not complicated. You can think about what happens there. Just like, for example, current liabilities. I'll give you another example. What if accounts payables go down during a period? If accounts payables go down during a period, it means that you have paid more than you've bought on account overall. Now keep in mind, during the year you might have performed a whole bunch of transactions, but we're summarizing it in one. So if accounts payable went down, we would subtract that from net income, because technically the fact that your accounts payable went down during the period means you paid more, cash went out, but that's not being reflected here in net income. So you would go in there and subtract it from there. Okay, so that's the main analysis for all your working capital accounts. Now I want to add a few more that sometimes can confuse students. So we'll look at a few type of transactions that you should know by now. These are items you've learned in your intermediate accounting courses, and at this point should be able to figure out how they affect the statement of cash flows for the indirect method. So we'll start out with this one, depreciation. Okay, this is your typical journal entry. You debit the expense and you credit accumulated depreciation. Well, this is an expense that was reduced from net income. So I'm sorry, it was reduced to arrive at net income, but it did not require a cash outflow. So because of that, you're going to add back the depreciation expense to net income as you prepare the statement of cash flows. Okay, so you'll have, just for the heck of it, let me do a statement of cash flows right here. You'll have operating activities as the first section. Of course, this is a simplified statement of cash flows, but you would have net income as your beginning amount, whatever that may be, and then to that you're going to add depreciation. Okay, this is the way you would do the operating activities. Net income plus the depreciation of X, whatever that may be, you would add it on. And what we'll have is, in the operating activities, you'll have a whole bunch of items that we're going to add and subtract to arrive at the cash flows from operating activities and the net of that. So hopefully, obviously, we want this to be positive, right? We want to generate cash flows from operating activities. All right, so that one's fairly easy to understand. The depreciation or amortization, for that matter, it's all the same. These are expenses that do not require cash outflow, so you add it back to net income. If you've recorded an impairment on property, plant, and equipment from the past, okay, you debited a loss and you've credited the accumulated depreciation for that asset. Again, this is very similar to depreciation. You've recognized a loss, so net income has been net income reflects that loss, but the cash out did not go out, so you got to add it back in. Okay. Loss on sale of property, plant, and equipment. Okay, well, same thing. Look, you received cash of $8, so that's reflected in the cash account. But you have a loss of $2 that reduced, that was used to arrive at net income, right? But that loss did not have a cash implication, so you got to add it back in there so that, again, we go from net income to cash income. And the opposite is true for a gain on the sale of property, plant, and equipment. Okay, so the gain on the sale of property, plant, and equipment would be subtracted from net income. And think about this. The cash that came in was $12. Okay, and that's correctly reflected in the cash account. But furthermore, you have included $2 to arrive at net income for which there was no cash inflow. So to go from net income to cash income, we're going to subtract out that gain of 2 from net income. All right, another one that is commonly confused by students is the amortization of discount and premiums on bonds. So let's look at this. Let's look at these two right here. Let's start with the discount. So just to kind of refresh your memory, if you sell a bond at a discount, you know, this is the face value. Let's say you sell it for $5 discount, so you get $95, and this is how it would look. When you recognize interest, periodic interest, and by the way, I'm just making up these numbers so that you see the flow of information. When I amortize this discount as a credit, okay, I'm making the expense greater than the cash outflow. So what we're doing is we're making net income go down by 4 because of this expense. But technically the cash outflow was only 3. So to go from net income to cash income, I'm going to go in there and say, okay, add that discount back so that we don't reflect an expense or a cash outflow of 4, but only a cash outflow of 3. And that's how that would affect it. So this gets added back to net income, the discount, the amortized amount of discount. Opposite is true for the premium. Notice how the premium, when you amortize it, gives you a smaller expense than the cash outflow. So net income currently reflects a deduction of $2 of interest expense currently, but cash went out was 3. So when you subtract out the premium amount of 1 from net income, that gets you to the cash outflow. Okay. What's another one? Oh, with regards to bonds, this was from way back then, but sometimes when you sell bonds, you have bond issue costs. So the underwriter might charge some fees to sell these bonds, and we refer to those charges as deferred charges. So assume we sell a bond at par. So it sells at $100. And normally we would get cash of $100. But if we have a fee that is incurred, $10, let's say, then we would account for it as such. We capitalize that fee. I know it sounds weird, but we capitalize that fee. And then over the life of the asset, that's how we expense it. So when you have these bond issue costs, the amortization of the bond issue cost of $1, this would have to be added back to net income. Okay, because this expense right here was used to arrive at net income, but that really did not require a cash outflow. So that's what we're putting that back in. Now, sometimes these things are combined, right? I'm showing them separately here, but sometimes they're combined and they can be very tricky. So when you're analyzing them, you want to maybe separate them, and if that makes it easier for you, then go ahead and do that. But sometimes companies just bundle it all together. All right. We'll come back to this one. This is a separate item. What about deferred taxes? Okay, you learned about deferred tax liabilities and deferred tax assets, right? So I'm just going to explain the deferred tax liability example, and then naturally the opposite is true for the deferred tax asset scenario. But suppose you're in a period where your net income per accrual basis is higher than your taxable income per tax basis. So if this is the case, you'll have a financial reporting expense higher for taxes than what you're actually going to pay the governing body, right, for taxes. So what ends up happening is that here's your tax expense based on net income, but here's what you have to pay the taxing authority based on your taxable income. So this gives rise to a deferred tax liability. And when you have an increase in a deferred tax liability, you're going to add it back. Let me see if I can do something here. You're going to add it back because net income is reflecting, net income is reflecting in a tax expense of 5, but really the cash outflow was only 4. So this $1 gets added back to net income to arrive at cash income. And then the opposite is true if your net income is lower than taxable income. If this is the case, if your taxable income is higher, you're going to pay higher amount of tax than you're going to recognize of expense for accrual purposes. So when you have that scenario, net income is only reflecting an expense of 4, but your cash out was 5, so you need to subtract out 1 for the decrease in the deferred tax liability. Okay, let's look at the next one here. So these are just common. The main idea is that changes in working capital accounts are the ones you add and subtract, right? And if current assets go down, you add them. If current liabilities go up, you add that to net income. But then what I'm illustrating here are some of the trickier ones, some of the ones that maybe you might have a little bit of a challenge with, okay? So here's the next one. You learned about pensions, and with defined benefit pension plans, sometimes you are underfunded or overfunded, meaning that the expense for the period for pension expense might not necessarily be the same as the amount of cash you pay for that period. So whenever the pension expense is greater than the cash payments, what are you going to do? You're going to add that difference to net income because, again, the expense reflected in net income is 12 when your cash outflow was only 10. So at that point, you would add back those two to go from net income to cash income. And then the opposite is true here. So I'm not going to illustrate that as you can do the opposite analysis, right? All right, another thing you learned about was accounting for investments. So you have the scenario where you might have a passive interest. That's when you own less than 20% of the shares of another company. So we're talking about an equity investment in another company. Or you might have the scenario where you have a significant influence over another company, and that's when you own 20 to 50%. So you may want to go review the accounting for that so you can understand what I'm describing here. If you have an unrealized loss on an investment accounted for under the fair value method, okay, then what you do is you debit that loss and you reduce the investment amount. This is after you mark to market periodically because you're carrying that investment at fair market value. So at the end of the period, you look at what it's worth and you might have to reduce the value of that investment if the market price is lower. When you do that, you're marking to market, right? You're recording at fair market value, but this loss doesn't necessarily require a cash outflow, right? But net income is reflecting that loss. And if we're going from net income to cash income, then you need to add back that amount of loss. And again, the opposite is true here. If at the end of the period you have an unrealized gain, okay, that's great. That increases income, your net income, but that increase in net income does not involve cash inflow. So because of that, I'm going to subtract that amount from net income. All right, and then finally, if you are accounting for an equity investment under the equity method, all right, and you have losses. So when the company you're invested in has losses, you have to take a share of those losses into your books. That's the equity method. So when the company reports their losses, I record a percentage of those losses, and the percentage is based on my ownership as follows. I debit income, which reduces net income, right? And then I reduce the investment itself. But again, this reduction in income does not require a cash outflow. So to go from net income to cash income, I got to add it back. And then finally here, the other one is the share of income from a company you're invested in that you're accounting for under the equity method, right? So when that company you invested in reports income, again, you take part of that, the percentage that the company reports X amount, and you'll include X times whatever percentage ownership you have. So let's say that this is $10. So that increases my investment, and at the same time, it reduces, it increases our net income. Now, since the company is reporting income, you might have a dividend you receive later on, right? Part of the profit distributions. And if you do, then that's cash that comes in for $2. So that's being reflected in cash. And then you reduce the investment. That's just how the equity method works. So if you're having a hard time understanding this, go back and review the equity method. If this transaction happens by itself only, okay? Let's forget this one down here. Let's just look at this one. If you were to analyze this one by itself, then you would subtract these $10 from net income because that did not come in as cash. Now, often when a company has profits, a company we invest in, they also have distributions. So this is where this comes in. If you have distributions from an equity investment, then you're going to debit the cash and you're going to reduce the investment. Now, how do you handle these two things on the statement of cash flows? Well, you take the net effect of the increase in 10 and the decrease in 2, which is a net effect of 8. And since this, again, the $8 is an increase in income for which you did not have a cash inflow, then you would have to subtract it from that income as such. Okay, so hopefully some of these will help you in being able to analyze how you account for these items under the indirect method. Keep in mind there will be a follow-up video where I'm going to actually do one complete statement of cash flows, and then I can show you the steps that I use to prepare the statement of cash flows. So be on the lookout for that video.